For years now, the housing market has belonged to the buyers with record low mortgage rates, but it may not last much longer. This week, the average for a 30-year fixed loan rose from less than 3.6% to more than 3.8%, the highest in more than a year. Michael Santoli is a senior columnist for Yahoo Finance. Michael, good morning.
Morning.
So what's going on here, Michael? Why is this happening?
Most directly, what's going on is the rate on U.S. government bonds has been going up. And basically, that's because the economic numbers have been somewhat better. People are pricing in a better economic recovery. And also, the markets are looking toward the time when the Federal Reserve is going to be doing a little bit less to tamp down interest rates. So basically, it's kind of a good news reason. But these rates obviously have gone up pretty quickly in a very short amount of time, although at very low levels historically, still below 4% for a 30-year fixed. I mean,
pretty nice
most
deal
times
still.
in history, it's very, very low.
Totally. That's what I was going to say. It's still very good. But of course, when you see a change like this, you get a little nervous. What does this mean for the housing market?
Well, it does actually feed into a housing market that's already kind of strengthening. Prices across the country in most markets are about 10% year over year. That's obviously been good news. I think what it means is it's going to potentially catalyze some buyers to say, maybe I have to move now. I don't think rates are going to keep shooting higher. You can't really handicap that very well.
Right.
But obviously the lows in terms of mortgage rates have probably been seen, and therefore there's no real, doesn't really pay to wait necessarily.
Meanwhile, we've got a 10% rise in home prices in the last year.
Yeah.
A lot of buyers have been sitting on the sidelines because they didn't like where prices were. Do you think they're going to start getting back in now?
I think there is a sense of urgency building into at least some markets around the country. And I think one of the issues we have here is that supply has been constrained. Basically, a lot of sellers, potential sellers, are still underwater, or if they sold their house, they wouldn't really earn enough to have a down payment on a new one. So maybe up to 40% of potential sellers are kind of stuck. And so supply and demand is kind of a mismatch right now. So I do think buyers are getting a greater sense of urgency.
You talked about not expecting the interest rate to shoot up, but what about the price of houses? We see this increase now. Where will it end?
Price of newly built houses is really seemingly going up pretty quickly. If you really are in a market for a new home, they have pricing power, the home builders right now. But I do think that it'll be a choppy increase in home prices. It obviously depends on the market. I don't think 10% a year is what we're looking at. We're not going back necessarily toward the 2006 highs.
But there are some people now, I'm starting to hear some people suggest we may be headed for another bubble here. I mean, do you think that's possible?
I don't think it would be a broad-based bubble, but I do think we have kind of an impaired market here because a lot of investors and speculators are kind of creating some frothy markets in some parts of the country. So I don't think it'll be the same kind of broad-based bubble fed by very lax lending standards like we had last time around. But I do think that we have the potential in isolated areas to get to some excesses. And I do think, again, because we have so many of these artificial constraints on supply, it's distorting prices in some areas.
How much longer do you think we'll have interest rates in this low territory, Michael?
I don't think they're going to shoot that high. I think we're going to kind of probably trend higher, grind higher in terms of rates. And by the way, if we do shoot higher, it's probably because of somewhat good news because the economy is probably strengthening faster than expected.
All right, Michael Santoli, thanks so much.
Thank you.